I'm recording.
All right, everybody ready?
Let's go.
Get it. All right, so Theta Gang. This is a strategy that we kind of just started really digging into here in the past month or so. It's a relatively low risk, can be very high reward, advanced option strategy known as triple income strategy or the wagon wheel method. All right. So the first step in the wagon wheel or triple income strategy is selling a cash secured put. The only downfall of selling a cash secured put is the amount of capital that you have to use as collateral for selling the contract. When selling a cash secured put, mindsets that you can have. You can either go further out of the money and sell it with the intention of it expiring worthless just based on the distance from the current price of the asset. Oftentimes, but not always, delta can give you a relative probability of the likelihood of your contract being in the money at the time of expiration. So with a 30 delta, you have a 70% chance of being out of the money at the time of expiration, in which you would just collect all of the premium without being assigned. That being said, that is not a guarantee. As we see with a lot of the call options that we get into, there will be times where we get into a call option that has a 30 or 35 delta, and that ends up being, $3 or $4 in the money by the time that we get done with that,
E-
whatever call it is.
Especially with
So
how crazy
it's
the
just,
volatility is right now. Sorry to
yeah,
interrupt.
especially with the amount of volatility we've had in the market right now. So this is just a relative probability. This is not anything that is dead set, but when you're way further out, going in deeper expirations, which is more beneficial whenever you're doing Theta Gang to collect more premium. It's a good final confluence for getting into a certain contract if you are going into it with the mindset of not getting assigned and just collecting premium. Right. The other mindset is you could be selling a closer to the money put with being bullish on the asset because of a liquidity zone or because you want a higher likelihood of getting assigned said shares. In return for the higher strike, you would be collecting a higher premium, which could also bring your cost basis down for the shares, and you could get assigned even lower. You know? So one thing you need to know is without a margin account, you need enough on hand to purchase 100 shares at the strike price to sell. So whatever it is that you choose times 100, that is the amount of equity that you're going to have wrapped up in this trade until you buy to close the position. So you are selling position and it's going to take, say it's a Fubo 35 put. So that's $3,500 that you're going to have to put on the sidelines until you buy to close this position, right? So getting assigned and cost basis. The second wagon wheel strategy is getting assigned. Your contract is closed in the month you have been assigned your contract, and your collateral has now turned into shares. As long as you should be in a solid liquidity or a price point to where you're in profits or close to them thanks to the premium that you collected for selling the contracts. That is our cost basis. We got some nice fucking shares at a nice discounted price, almost like a paid limit order. That's my favorite part about this. If you see something that you really like, if you see some shares that you really like, you don't like the price it is right now, you can sell puts on it, collect premium, and you can have that as your limit order to purchase those 100 shares. So you're getting paid to have a limit order, and if your limit order doesn't get hit, you're still getting paid. So we take the amount that it costed to purchase those shares and subtract the amount of premium to see what the cost basis is. So the formula for that would be the price of the shares from being assigned minus the premium collected from selling the cash secured or cash covered puts is your cost basis. An example is we sell to open a Fubo 35 cash secured put for 360 when Fubo is at $37 per share, and by the time of expiration, Fubo closes at $34.23. We are now in the money and had to purchase those shares at $35 each. But by calculating our cost basis, we can see that we are still in profits. So you had shares for $3,500. We collected $360 of premium. for selling that cash covered put. So our cost basis is now $3,140. So at the time of expiration, FUBO is at 34.23. So 34.23 minus 31.40 is $283. So you are at $283 in profit at time of assignment. That's not to say that that's going to happen every time that you get assigned shares,
And
and you
so
don't always have to assign shares. What's up?
so
Go ahead, bro.
that's where your break even comes in. That's how you calculate a break even to for your contract. And if you're gonna when you get assigned, the more credit you have, the further down your break even is. And so let's say, so you have on this example, you have a 35 put that you collected $360 worth of credit. So 35 minus 3.60, your break even, Fubo can go all the way down to $31.40 before you lose money. And with a percent wise, that's a 10% move down from your strike price. And if Fubo's at 37, that's about a 12% move. And so your probabilities of being able to actually lose money on these is very, very, very low.
Most definitely. So that is your cost basis. Cost basis is something that you always need to keep in mind, especially if you have intent of being assigned shares in order to sell cash covered calls. All right. All right. Selling covered calls. Uh, Selling covered calls. Once you have sold your put, gotten assigned, and received your shares, it is now time to start selling cash covered calls. We are selling calls. We are selling to open a cash covered call. Cash
You're
secured
you're
call
you're cutting out here and there, just so you know.
Yeah, you turned into Mr. Roboto.
that we sell. This is where the wheel kicks in. So when we sell that contract,
Still happening, fam.
all right, can y'all hear me?
Yeah,
Do
you
you
want
have
to just
your
restart this whole covered call one again?
cell phone near your computer? I heard it ding, so if you do, just move it because you might be
Yeah, my
getting
bad, bro.
messages and it fucks with your Wi-Fi.
Yeah, that was my
You're good. It just fucks with your Wi-Fi, the signal.
yeah. I'm turning my phone off now. Uh, gotten assigned and received your shares. It is now time to start selling covered calls. When we are selling calls, we are selling to open a cash secured call. We are obligated to sell the 100 shares at whatever strike price that we sell. This is where the wheel kicks in. When we sell that contract, we are receiving a premium for selling the contract. If it expires worthless or out of the money, we keep the entire amount of the premium we collected. If we get assigned, we get to keep the premium that we sold as we realize profit from the difference of the cash secured put and the covered call strike. All right. So an example would be the cash secured put we sold on Fubo is assigned to us. So we sell to open a $40 covered call at $4.20. So $420. Fubo closes. That was supposed to be 42.15. Or no, yeah, 41.15 at expiration. So our cost basis for the Fubo shares is 31.40 because of the premium we collected from selling a secured put. We sell our shares at $40 each, receiving $4,000 for the sold shares. So $4,000 minus the 31.40, which is our cost basis, equals 860. That would be the final share price minus the cost basis. So then you can add in the premium that you collected for selling the covered call plus that, and that is your capital gains plus your cash covered profits. So total profits is $1,280 from an original capital risk of $3,500 for just over 35% profits, usually within 2 to 3 months' time.
With
The reason I
little
say
to
2
no
to 3 months'
risk.
time, little to no risk, right? So the reason it's usually 2 to 3 months' time is a lot of times you really want to be 30 to 45 days away from expiration to really have the highest ratios for your Greeks and your premium. So if you're 30 to 45 days out from expiration, your premium is going to be a lot higher. And then after that 30-day period, once you break into 30 days, your theta is really going to start kicking in at that point. So you're just going to be collecting a higher rate of theta all the way up until expiration. All right. So can you see my screen, Hunter?
Yeah, for sure.
You want to run over this real quick?
Yeah,
I got to get my kids.
you're cool.
I'll be right back.
So some tips and tricks. This is one of the few situations other than spreads when margin account works, and Tasty works is very, very helpful. Sometimes I was saying earlier, you can only like say that Fubo cash secured put, it costs 3,500. You could, if it wasn't hard to borrow, which I'll explain a little later, you can actually get that for about 20% of the cost needed in that actual covered call, in that cash secured put. So not every stock does that, but certain ones, if they're extra volatile, I actually think Fubo is considered hard to borrow, which means that you have to have all the cash in your account to do that sold put. But you can, when a stock isn't too volatile, then you don't need as much with a margin account, because to buy those shares you don't need as much. You will not always get assigned on your contracts. I mean, lots of times you can just keep rolling it and you don't need to get assigned if you don't want to, and you can keep collecting extra premium. Delta is most of the time is used as a really good indicator of the percentage that we are going to be for, to be assigned. So if it's a 30 delta was our example, you have 70% chance of getting assigned. A lot of times when I sell puts, I go for like a 20 delta usually. You get at about an 80% chance. And it also depends on the premium of that specific contract as well. Be aware of your cost basis and always sell the covered calls that are above your cost basis to ensure you're in profits. That just means, say you paid 31.50, you want to sell at least a $40 covered call at a very minimum. Lots of times when I sell covered calls, I go out even a little farther. I'll go a 16 delta, a 5 delta, something crazy like that. Maybe only collect 20, 30, $40. Oh shit. His stream ended. Brody, where you at?
You having internet issues probably.
Okay.
It's okay.
That's fine.
He'll be right back. He's probably not there and it cut out.
I'm gonna share Tasty real quick then.
There we go.
You guys can see mine?
Yes, sir.
Okay. Broham can stream once we'll finish this once we're doing. So like I was saying, lots of times I'll go out to, I was looking at AMC just because it's got a 500 IV. When you do sell puts, a lot of times it's best in a high IV environment. So I go and look for something that's 100% IV. I mean, usually like naturally a 50% IV, high IV environment, but right now we have incredibly high IV, with GameStop having an 800 IV, AMC having this 535 at a 20 days out. And so what I would do, generally I don't do 20 days out, I do 30 to 60, 30 to 90 days out, 45 being ideal. So I would go to March, sell like a $6 covered call. It's only got a 10 delta. That means you have about, well, with how volatile it is, you have less of a percent, but generally you only have a 90% chance of it being in the money at expiration. Because of how volatile, the expected move of AMC is $14 by March 4th, by March 19th. This right here, IV, the plus minus 14. That's the expected move for this expiration day. So it's expecting to move up or down $14. That means it could go to 0, or it could go to 28, or it could go anywhere in between. And so a lot of times, generally, this would be 10 delta would be about a 90% chance. So, and notice how at $6, it's costing you $6. Your strike price is $6, so 600 for 100 shares minus the 222 credit that we receive. It's only costing you $378. Yes, it's a meme stock, so fuck, anything could freaking happen. I sold puts in GameStop when it was at $50, and now it's at 350. The IV has gone up so much that I'm pretty much 100% down on my puts. I'm negative almost 100% because IV's just gone crazy. It's gone up so much. When I looked at it, it was at about a 200% IV. I was thinking, oh shit, like this is really high IV. It's gonna go down. That motherfucker went up so much that I am down, even though I have appreciated 300 fucking delta points. It's nuts to me. I've never seen it. But I'm not cutting the contract because I'm $300 out of the money. There's no reason to cut it when you're that far out of the money, even though IV's clapped you. So eventually could go back down, or it's just gonna expire worthless. As with mine right now, the GME puts, I have about a 30 delta. I'll go back to it, or a 30 theta. I called out the March ones. So it's all the way down here. We collected about $3. It's a 28 theta, positive 28 theta. So every day I'm holding this, I'm collecting $28. So there's no reason to cut it. But IV fucked me on this. So yeah, that was one thing with the AMC is you never know. IV could fuck me, but it's such a high IV. Like look at this, 3,801% IV. That's fucking nuts. I've never even seen that, especially in a $325 stock. 369 IV, it has an expected move of $320. That means it could go to $5 or it could go to $650. 645 to be exact.
Looks
In
like
20
Tilray
days.
when Tilray had the volatility issue.
Yeah, exactly. And so this is just fucking crazy. This is insane to me.
Alright, so what you're gonna do is click on it and hit full send.
Yeah. Brody's still gone. Okay, cool. Let me know if you guys have any questions. And so with covered calls, I'll go to NNDM. We were talking about covered calls a lot of times. You can go out. So I have shares at NNDM about $9 right now. That's my average. I'll go out 30 days. I like to collect about $100 in premium usually. And with something like NNDM, I do not fucking want to sell my shares. And so I go further than the expected move. I would go as far out as you can to collect your extra credit and to make sure that you do not get assigned on your shares. Because if you want to hold your shares, then you don't want to get assigned to your covered calls, especially if you have long-term shares. So you go out further out of the money just to collect some free cash, literally. I don't know if this is a bad question, but how does IV change? How does IV change? Is it based off volume? Pretty much. IV changes based off of the movement of the stock going up and down, and then also the amount of people that are piling into that stock. And so you notice when stocks get close to earnings, IV gets jacked up because so many people that stock is so sought after and it's moving so fast up or down. So many people are getting into it that it's raising the IV. And then after earnings, everybody gets out of it and IV just drops. And so it's a lot of times it's based off of the volume that of the contracts being people being in and out of those contracts. Broham, if you're back, we can rescreen you. We can redo your screen too.
That was my bad. Give me just a second. My Wi-Fi's kicking back on.
You're cool. Let me know when you're all ready.
Yeah, bro.
I'm just gonna keep going on cover calls then.
Definitely. Go over it.
So generally with covered calls, just like with anything else, when you're selling naked options, you want to stay 20. Like personally, I know Playboy does them. Playboy will go super far out of the money in a really short dated, which I have no problem with. That's perfectly fine. He loves in a really high IV strategy. That's beautiful. It works perfectly fine. But like if you were to do a 20, if you were to do a 20 day for NNDM, like you don't really know where NNDM is gonna go in 20 days, because especially with the stock market right now, so like I would want to sell really far out of the money, 25, 30, 25, 22.5, somewhere around here, two standard deviations away, and that way you can make sure that you don't get assigned. If it's something that you don't want to get assigned on, if you have no problem getting assigned and you don't mind getting rid of those 100 shares, you can sell it a little closer at the money. This is also might be a dumb question, but why don't you just go far out and sell a put that's basically the guaranteed worthless and then just walk away with premium? Far out of the money or far out in expiration? Clarkson. Far out of the money? You can. And this is the reason why though. So if you go $40, 45 days like I normally do, and you want to go like really far out of the money and just guarantee you're 100% gonna get you're gonna get it's gonna expire worthless no matter what. Like there's no dumb questions, just like Zamrock said. Ask everything. This is new to everybody here most likely. So if you want to go really far out of the money, what the reason is why I don't is because the risk to reward isn't quite there. And so if you look at NNDM, which is a really good example, if you want to go like 7.5, the stock price is at $13, and if you wanted to do like a 7.5 or a $5 put, then it has to have a 50% move down for you to get in the money on that. But look at the amount of credit that we receive. You only receive a $28 credit for risking $412. And so for me, it's all up to you. But for me, if you want the return on capital isn't just quite there. And so you want to do something that is going to have a little better risk to reward. Like a $10 would be fine. You're collecting $100. You know it's going to be good. It's only costing you $600. And so I focus a lot on the risk to reward of these AMC. Like with these really, really, really high volatility stocks, you can go further out of the money. And that's why you look for like really high volatility, because you could do $5 AMC or a $3 AMC where it's only costing you $275 to collect $25 credit, which is a 10%, almost a 10% profit in 20 days. That's perfectly fine. 10% is great. But this one, if you go up to $4, let's just say, you're at about a 15% profit in 20 days. You got a $340 it's only costing you for you're collecting 60. So as you go up a little closer in the money every time, the percentage of profit is going to be a little better. So what I do is I try to find the best risk to reward for the highest probability of profit. Generally, I want it to be about a 65-70% probability of profit, and I want to collect about a third of what I'm paying a lot of times. So, I mean, with cash secured puts, it's going to be a little different, but I want to collect at least $100 usually.
And especially this is one place where you can most definitely uh, take advantage of those high IVs.
Yeah,
So if you have something
absolutely.
that's been moving absolutely insane, I mean, this is one of the few times where it's if you could find something out of the money that had a decent return, you could get somebody. You could be on the opposite end of an IV crush, and you could get in there and sell that call or that put and be able to collect a lot more theta or IV up front from somebody just because of the IV spikes. It's not to say that you should do that in GameStop right now, though. Can you see my screen, Hunter?
Let me look. Hold on, let me answer Tyler's question real quick. So Tyler, if you look at my screen, I can show you a really good example. So open will do. Generally, if you want to do, let's say you want to do a $20 put, it's going to cost you $2,000, correct? 20 times 100, 20 times 100 is 2,000. So I have an IRA account. I don't have margin on it, and so I do, but I don't have this type of margin on it for selling puts. So it's costing me $1,865, $1,865 for a $20 cash secured put. But this is where your margin accounts come in handy. I go on my margin account. This same contract that costed you $1,865 is now only costing me $210 worth of buying power because of how margin works and how it works with your brokers. And so this is why I highly recommend Tastyworks for anybody that wants to fucking do this, because your max loss is still that 1,865, but you don't have to have that whole amount in your account to play these plays when you have a margin account with Tastyworks. It's called, and I don't know if it happens right away. I think you kind of have to prove to them that it works. But a lot of time, but like it's only costing me 20% of what it should. It's 10%. It would cost a normal person $1,800. It's only costing me 210. Or not a normal person. A cash secured put will cost 1,865. So yes, it's rough to have 400 to use 4K to get $500 in return, but it is almost free money. And when you have a margin account and when you have the right broker, your cost basis is way less. Alright, we're gonna go back to this. Boom. Go back to our slideshow real quick. We'll finish this up and then I can answer more questions.
Where did y'all leave off?
At the very beginning, hold on. Delta could be an indicator, be aware your cost base is. If you're getting if you're getting as close to getting assigned, but you have collected some theta by purchasing a contract some time ago, and you do not want to get assigned, you can roll the contract to a later date to receive more contract and more premium and have a lower strike or a higher strike at the same amount of premium. And that brings your break even lower. And so that's what I was saying with your break even. Let's just say Flank, he had a Fubo put. I don't think it was a $30 Fubo put. Fubo was getting close to $30. It was about 28. He was collected some good data. He could have rolled that contract from February to March, let's just say. I don't know his exact expiration dates. He could have rolled that contract from February to March, collect an extra $100 in premium, let's just say as an example, and your break even. What was our original? We originally collected what, $3, Brody?
Yeah.
Okay, so let's say you originally collected $3. You add $100 onto it, and then now you break even goes from 33 to 31 or 32, and so that adds to your break even. Since you collected more credit. If you are doing this on certain stocks at the right time, you can actually receive dividends during this process, which adds an extra leg of income. That's something that I don't know much about, but that's a fucking fantastic idea. If you get assigned and you happen to do this right around the dividend area, you get assigned, catch the dividends, sell covered calls, and now you just got three different sources of income. Fantastic.
You get,
Excuse me.
and now you get to keep, a percentage of a share or a share. And you sell those shares and you get to keep whatever you have left. So that's a pretty cool part about this. So you need to make sure that you have the capital in order to sell the calls and not put your entire port into one position and have that capital locked up until you buy the close or get assigned. So this is what we're talking about. If you have a margin account, that's awesome. If you don't have a $3,000 account and sell a $28 put on something because and then and if it goes south, whatever it is just tanks, then you're gonna be signed. Game. So this is not buying calls or day trading by any means. A lot of people consider this the Warren Buffett method. Warren Buffett is actually notorious for doing this quite a bit. It takes time and patience in order to be truly profitable at this. So we can get some awesome gains on some weekly calls, some next week calls, insane gains on some 0 days. You can have insane gains on this as well. But this is not just like all trading. This is not a get rich quick scheme at all. All right. So for Theta Gang, you don't always have to go with the mindset of purchasing a position. You can go in with the interest of just collecting premium or Theta from another trader that purchases your call. You don't have to
Hold up, you're cutting up again.
go in with a wagon wheel strategy. You can just go in with the intent of, hey, here in this zone, I'm going to sell this put, and then all right, this is just like any other trading strategy. You need to have your technical analysis in check and practice your risk management. You can still get burned doing this.
I think we might have lost you again.
Do not go into any Theta Gang
Oh.
or wheel method thinking that you'll realize guaranteed gains. You need to find your liquidity zones, your price action levels. Fubo actually was puts. Some people sold some more of those puts and collected a lot.
Damn, we lost him. Broham be dead.
I'm all out of
We all need to
love,
go up
so lost without
we all
you.
need to go up together and build a fucking Wi-Fi
Dude,
thing right by
so that
Broham's
was one of
house.
that was one of my businesses that I was gonna get into. Me and my boy, we were gonna put up fucking towers, bro. It costs you like
Yeah,
$5,000, and then
we
you
got
fucking rent it from Hurricane Electric,
we gotta
and you
build a
can sell
tower
internet.
right by
Yeah, it costs
Broham's
like
house.
5K, and then you rent the line from Hurricane Electric, which is like the provider that provides half the world with internet, and then you get a direct feed from them, and you sell secured storage and internet to local people. It's pretty cool.
Can y'all hear me now? My bad, guys.
Yes,
Yeah,
sir.
Ridiculous.
we're talking about building a
Internet
building an
tower.
internet tower in your backyard.
That would be awesome. I actually have Comcast coming out next week to give me some 5G action. So
Let's get it.
hopefully no more of this garbage.
Let's
All
get it.
right. Last thing on this one is this is supposed to be a strategy that is very low maintenance that you can use to accrue profits for you on the back end while you maintain your day-to-day trading, scalping, day trading, and swinging. You know, this is very low maintenance and can be very high reward. You're going to have to set some capital aside and you're just going to have to wait it out. This is a waiting game, but this can be very profitable on the back burner for capital that you're not using, that you don't plan to use. All right.
So this is an investing strategy. It's not a day trading. It's not a get rich quick. This is a strategy that's gonna profit over time and keep you consistent. And that's one of the things that why we started this and why we are going on it so much is because it is the one of the safest strategies in stocks. It is one of the best strategies for new investors, so they don't get burnt on this bullshit like GameStop.
Most definitely. And once you build up your portfolio to, insane numbers, you can start doing selling some spy calls 3 times a week, like some crazy money. So, in essence, what we are trying to do is sell premium. We're selling the contracts that others are wanting to buy. The reason that Theta Gang is such an awesome part of the money mob is that with enough time and patience, you cannot lose. We're selling puts on something that we would like to own at a price that is in a solid liquidity zone or price action level where we want to own them. When we sell those puts, it's a win-win situation. You either let them expire worthless and keep the premium for the contract you sold, or you get assigned and get discounted shares and still get to keep the premium. Once we get those shares assigned to us, likely already in profits because of the premium collected, our cost basis, we can then begin selling covered calls on those shares. Once again, if they expire worthless, we keep the premium. If they get assigned, we get the difference from where the puts we were assigned from to the call strike, as well as the premium for both of them, and then just rinse and repeat. Just keep that wheel fucking moving, man. It is a wagon wheel strategy. This is a rinse and repeat strategy. Sell a put, get assigned, sell a call, get assigned. Just keep that wheel moving.
All right, and so I'm gonna answer Clark's question real quick. Clarkson's question. He says, "So would you guys say the ideal situation for a Theta Gang is for your sold puts to expire worthless, or and walk away with the original premium, or do you profit more if they get filled and then sell the covered calls?" So to answer that question, there's actually two answers. There's two different types of investors. You can do it on a stock that you really don't care to own, and then yes, you would just want it to expire worthless, and you collect the original premium, and you keep on rinse and repeat. Or if it is a stock you want to own, let's say an NDM, plug, anything like that, you choose what strike you can choose what strike you want to own it at, and then make sure that say plug is at, I'm gonna go to uh is there more on your slideshow?
No, that's the last slide right there.
All right, so we're gonna go to my screen on Tasty.
Selena, go upstairs and play with Sissy, please. Selena, your dad is working. Go upstairs and play with Sissy. Daddy, get it for her?
And so we'll do it on plug. So like let's just say if you want to keep the stock, so let's just say plug's at $63 right now. Let's say you want to buy this at $45. You want to buy plug, but you don't want to spend more than $45 a share. You could sell that $45 put on plug, and hold on, let me go to my other account. I already have puts on plug. It's costing you 4,500. With a margin account, it's only costing you $450. And then if it gets down to 45 eventually, then you get your shares at the price you want. If it doesn't, then you keep your premium. If you don't, and then if it's something that, all right, well, I don't mind owning plug at a little higher, you can sell a little further out in the money. With plug right now, I would sell about a $50 put personally. 50 or 45, somewhere around there. And so I'm gonna go through the whole step by step by step on Tastyworks so we can see exactly what happens. So let's just do plug. We're already here. We want to own plug. This is a great company. We go 45 days out of the money. You go roughly, my minimum delta I like to do is a 17 or lower. So we'll just do 17 is a $45 put. In a cash account, it's going to cost, hold on, let me go to here. In a cash account, this is going to cost $4,160. You're collecting $335 worth of premium, 4,500 for 100 shares of this at a $45 minus $335 is 4,165. Everybody understand that math? Okay. So now plug stays above 45 at expiration. Plug just kind of tickles around the fucking 60, 50, 70 area that it's been doing right now. You collect this whole $335. No harm, no foul. But if plug gets down to, let's say $43. Plug gets down to $43 by March, and it at expiration. So when you get assigned, you're getting it assigned on March 19th at fucking 1 o'clock when the market closes. That doesn't mean March 19th at noon. It doesn't mean March 18th. When you get assigned, it's at the exact expiration date. So you have to hold this that whole time. Um, so generally, a lot of people, like, if they want to get assigned, sometimes they'll go a little closer and a little closer. Personally, I keep it at further expirations. So that's where if you don't want to get assigned, I actually just use my open. No, not open. I have one that was for February. We'll just do GME. So GME is for February. You can roll your contracts. Tastyworks makes it super easy to roll contracts. I don't know how fucking anything else does it. TOS makes it really easy. There's just a roll button. So you roll your contract. So now you have a GME put that was at 21 days till expiration. So you don't you want to hold it, you want to keep it for a little longer, uh, just in case. You want to make your expiration out further. So you roll it out to that March. You're collecting an extra $395. So that brings your break even all the way down even further. So we'll do the math. GME, hold on, I actually have. So we originally collected $370, $370, 3.70. We roll it out till March. Same expiration, we don't change anything, or same strike price, we don't change anything except the expiration. Roll it out till March, that same strike price, we collect an extra $395. So now our total net credit that we have 370 plus 395. So that's 370, 3.7 plus 3, 3.95. Now we've collected $765 of credit. So if GME stays above now, instead of if GME stays above 35 by February, we think it's going to stay above 35 by March. Just an example. Then we collect, instead of only collecting $300, now we're collecting $700. So we've brought our break even down lower. Our break even goes from 35 minus 3 would be 32. It goes from 32 all the way down to roughly right above 25. I'm not doing the exact math right now. I don't care. It's just an example. So you've gone right, now your break even's right above 25. So this just gives you a lot further of a way of a cushion in case it drops. And so most of the time, if you're negative on a contract, open. I'm negative on this contract, negative $80. If I roll it out to a further expiration, you're gonna gain more credit. No, pretty much no matter what, you're gonna get more credit. Your break even's gonna be down lower, and you have more cushion. So a lot of times, if you don't want to get assigned, roll it out. If it's getting close, roll it out. There's a lot of other ways to manage these. We can go into that a little later if we want as well. And so let's just say you get assigned and now you need to do covered calls. Go back to plug. Sorry, I went on a rant. We sold these $45. We sold these. Let's just say we sold the $55 call. It went down to 55, and then we it we collected the money. It came back up. Whatever. So now we need to sell covered calls and plug. Price is at 63.55. 63. Let's say we got the price at 55. So we've already got some extra cash just from the price raising from 55 to 63. What we would do is we would go out on 45 days, 30 to 45. Always do monthly contracts. I always do monthly contracts because your Vega value is better. Go out. So you want to keep, if you want to keep these, like generally I would just go out really far because look at how much premium you can collect at such a far out of the money contracts. That's pretty much guaranteed to collect. Like right now I have an $80 sold call in plug. So I'm bearish that plug's not going to go over $80 by March. That was a personal trade that I didn't nobody else would have the buying power for. It only costed me 650. If you have a cash secured covered call, you would need 4,600 and 650. So that's why I didn't call that one. Oh shit. Yeah, I know. I have PDT. But like, say you have you have your you have stock at 55 for plug and you want to sell covered calls, but you want to hold that 55. You don't really want to sell it. You want to hold it for forever, let's just say. You sell the 110. Go as far out as you fucking want. If you don't mind selling the shares, go out a little closer. There's no wrong way to do this. That's the best thing. So there's no wrong way to sell calls or sell puts. If you don't mind selling them at 95, you're collecting $30 for each share, then you're cool. Sell it at 95. If you want to hold them and you think plug's gonna go to 1,000 in 10 years, then sell it even further out at 110. Collect fucking $330 in premium instead of 465. It's $100 less. Oh well. You have to have 100 shares though, right? Just to straight sell covered calls. Yeah, to sell covered calls. You can sell cash secured calls, naked calls without the 100 shares as just a bear strategy similar to selling puts. Yeah, I've heard you can sell calls to exit a stock. Yeah, so like if you want to get rid of your stock and you have like if you have 100 shares of NNDM and you want to sell those, sell the calls at fucking the let's say 15, 13, 14 and you still make the extra premium for it too. But yeah, if you want to sell covered calls, you have to have 100 shares. You can sell naked calls without it as a bearish strategy, a bearish or neutral strategy, similar to selling puts. So when we say sell a call or sell a put, it's opposite of what you would normally do. So when you're buying a call, it's a bullish strategy. When you're selling a call, it's a bearish strategy, a bearish to neutral strategy. When you're selling a put, it's a neutral to bullish strategy. When you're buying a put, it is a bearish strategy. So they are opposite. You kind of have to remember that when you do them. So say you want to do covered calls and plug. Eh, plug is too expensive. We'll say open. It's cheap. And it's not hard to borrow. Covered calls and open. Make sure I'm on my right account. Yeah. So you're getting 100 shares of open. Let's just say at $26. You can sell your $30. Well, I'd go further out in expiration, not. Yeah, so he says, I may have missed this, but let's just say my original plug 45p got filled for 319. What expiration am I looking at for my covered calls? So if you have a 45p that got assigned, that means now once it's assigned, now it is March 19th, and so you would go 45 days out from that date. Now it's March 19th, so the next expiration would be June or May. So you would want to do one of those. You don't do them both at the same time. I mean, that's called a strangle if you do them both at the same time. And you don't get assigned until expiration date. So let's say you want to sell covered calls and open. You don't mind buying open right now at $26.12. You can sell your covered calls for an extra. You don't think it's going to go above let's say 35 by March. Collect an extra $150. It's costing you 2,600 minus the 150. So now it's only costing you 2,450. If you have margin, usually it's half of that because your stocks are paid. It's 50% margin in stocks. And so now you have, it's only costing you $1,100, $1,200, max profit of 1,450 if open is above 35 at expiration. If not, you keep your shares at $26, you collect this, and you resell more covered calls. So you don't have to let them go until expiration. If you get 50% of your covered call, so you're selling this covered call at 35, you collected $150 because it's an easy number, and now the premium's at $75 left, and you've collected $75 worth of premium, fucking sell it. That's cool. You collected your 75 bucks, it was free, it was quick. Not quick, but it was free, and you get out. If the stock goes up when you sell puts, then puts get expire quicker. So that goes into when you sell your puts, if you want them just to expire, like you were saying, expire worthless, then you go further out of the money. Further out of the money contracts expire quicker than close to the money contracts or at the money contracts. They go to zero faster. So a $20 put is going to decay a lot faster than a $24 put. A $15 put is going to decay a lot faster than a $20 put. So let's just say my original puts got filled. You mean assigned? So okay, so my original puts got assigned. Now you have 45. Now you have 100 shares at $45. So then I go and sell my covered call. Let's just say you sell it for $80. Is that trade over once I sell those calls, or does it ride till expiration till I'm finished with that trade? Which trade? I'm very confused. So then I go to sell my covered call. Is the trade over
Oh,
once I
it goes until your expiration.
the
You
covered
have to
call
ride
can
that.
go the covered call can go till expiration. The
But I
sold
mean, you
puts
can.
the sold puts won't become covered calls unless you get assigned at expiration of those sold puts. Usually,
Once
I'm just
if it expires in the money, your shares are sold for you automatically, and you just collect all your premium and the shares that you just sold.
so there's two different
But
trades.
yeah,
So he says I'm just trying to understand how to exit that trade and when that happens. there's two different trades. So you're gonna do one trade, and then you're gonna exit that trade, and then you're gonna do another trade. And so this is something you can literally do on the same stock for 10 years straight, and you can never exit it if it's something you really like. So let's say plug, we'll go back to your example. Plug expires, so you get your 45p in March. It's not gonna, that's your first trade. So this first trade, you exit this at either at expiration, or if it starts going up, you can exit it 50, 60, depending on the stock price. So let's say you have a 45 put and plug goes to $80, let's say. That $335 premium is probably going to go to $100. Let's just say you collected $235 of premium. You can exit that trade if you'd like because it's expiring worthless. If it starts going down, then you exit the trade at expiration at 40 on March 19th. That first trade is finished. Does that make sense? So now you're on to your second trade. If it becomes in the money, if you get assigned, that's when you do the covered calls. That's your second trade. If it doesn't get assigned and it just keeps moving up and keeps moving up, then you don't have to worry about it. You exit your trade, you move on to another one. I wouldn't continue selling puts because it moved up so high and it's ready for a pullback, usually. That made sense? Gets assigned. Now I own 100 shares. Now let's say I covered a call so go out to June 80. So then I will have to wait till June to get my original investment back. Yes. I mean, you don't have to sell the covered calls. You can sell the stock at the I mean, say plug went down to 43 and you still have, so if plug only goes down to 44 or 43, you still have profit in that trade. You still have $100 worth of profit. You can exit right there and get your initial investment out right there if you'd like. Or you can sell covered calls and continue and hold your initial investment and continue to sell covered calls. So it's really up to you as a trader and as an investor on what you want to do with that original investment. Do you want to keep those plug shares? Do you want to hold plug for 10 years, 5 years, a year? Or do you not want those shares and you can get rid of them right away, take your initial investment back, and then you can and move on? Let's say plug continues to go down and continues to go down and continues to go down. It goes from 45, fuck it, let's just say to 35. Then that's where you're gonna have to keep doing covered calls. You're gonna have to keep doing covered calls and keep doing covered calls. Potentially average down if you want more shares, or just continue to do those covered calls for long time until you collect enough to pay for your premium.
But you
Generally,
really always sell covered calls above your cost basis.
yeah. And so you're wanting to do this on something that you believe in, not on something that you know is gonna come back up, not on something that you is a shit coin or a shit fucking stock that is just gonna go down and it's just like a pump and dump. Like Plug is a good company, like Open Door is a good company. You don't expect them to go to zero. You expect them to have a pullback and keep going up, have a pullback and keep going up. And so this one that let's just say you have you're assigned at 45 and the bitch just goes to 40. You're not going to be able to get a premium enough to cover that cost basis unless it goes back up. And so you're just going to have to keep getting You're gonna have to keep collecting those covered calls to pay for your cost basis, and eventually it's gonna go up. I mean, a lot if you believe in the stock and you know it's a good company and it is a good company, eventually it's gonna go up. That's one of the things where
And
you have to.
that's where finding the liquidity zones and good cost basis really comes in handy. If you enter on the pullback, if you sell the put on the pullback, the premium is going to be at its highest point, and
Yeah.
then you can ride it out at that point. It'll be less likely to reach your expiration on a pullback than it would if you entered, the day after it runs up 10%.
So I'm gonna go to Tasty or not Tasty. I'm gonna go to Trading View, and we'll walk through this too on how you can find different strikes. So plug, great example. This is the one we've been using. Get rid of this. We'll keep our moving averages up. So plug has been consolidating. There's a gap right here. There's oops, I've done a lot of TA on plug. There's a gap right here. There's a little gap right there. And finally our breakout point of right here. You go to a further time frame. You see this is a big cup and handle. Liquidity zone right here, right where we had. That was perfect. Liquidity zone right there. Liquidity zone right here. And so you find these liquidity zones of where the bottoms are. And that way, alright, well, okay, if it's going to come into this liquidity zone, next thing, it's going to go down to this one if it breaks down. Or it's going to come back up to this one if it moves up. And so you want to make sure that you keep it at a good area of support and resistance if you don't want if you don't fully believe in that stock. If you don't mind holding it for a long time. That's why this is something that is an investment. It's not something that you do quick and you're gonna do. You can hold your initial investment in for years and years and years. Or if you want to just be a theta collector, sell some fucking puts. Never get assigned. That's fine. Go super far out of the money. If you wanted, let's plug is at 63. And you don't want to get assigned these shares, you don't want to risk getting assigned, fuck it, go all the way down to a $30 put, sell some extra, collect less premium, have a higher probability of being out of the money. Plug has to drop 50 fucking percent for it to go to 30. It has to drop, what, 30-40% for it to go to 40? Let's see, 45 was yours. It has to drop 25% for it to go to 45. 27% to be exact. And so you also put in these, think about it as like, alright, well, how far does it have to drop for it to become in the money? And what is the likeliness of that happening? Is this a stock that's super volatile that is gonna go up and down 20-30% in a day? Maybe. Plug is definitely one of those stocks that can go up and down 5-10% in a day, no problem. And so maybe you don't if you're worried about your initial investment. Maybe you do it on Corsair because Corsair's been are a little bit beat down. It has this range. You know that I already have my liquidity zones here. This $30-$32 range, $32-$33 range, excuse me, has been a good liquidity zone of it. So fuck it, sell one down at 25, $30 below the liquidity zone where alright, even if it goes down, it's going to catch support right here and pop back up. And then you never get assigned. If it breaks support, then you finally have to worry about it. But if it's been holding the support since November now, December 1st to be exact, November 30th. And so that's 3 months worth of support. And so it's all a risk to reward of what you want as a trader. That's why these are so good because no matter what, the probability of exiting the trade in a positive with profits is very, 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 very high. Generally about a 70% chance. And in trading, that's fucking incredible. Most of the time, our deltas are about 30 delta, 20 delta, and we only have a 20% chance. Thanks, bro. Have a good day. And so, excuse me. And so now it's all probabilities of your risk to reward. If you don't mind collecting more credit and potentially getting assigned, go further up on your strike price. If you don't want to get assigned, you just want to collect data, that's fine. I know I do that all the time. I fucking sell puts just to sell puts and collect data. Collect the premium and not get assigned. I have no problem with that. I do it all the time. It's perfectly great strategy. Tasty Works does it. Pretty much all they do is sell puts. They don't ever get assigned. They don't really hold stock. Tastyworks isn't like that. They have long term, but they don't trade stock. They trade selling premium. So selling premium is the safest way to trade options. Selling puts is one of the safest way to trade options. Selling covered calls is one of the safest way to trade options. If you're selling covered calls, make sure it's in a stock that you believe in. We'll go NMDM. It's one of our favorite. It's one of my favorites. This is gonna be fucking ginormous in 10 years. I have shares all the way down here at $9. I don't want to sell my shares at $9. I don't want to sell my shares at $22. I want to fucking sell my shares at $40, $50. I'm gonna sell super far out of the money calls just to get free money. Cause I know in my 22.5s, it's all the way up here. This motherfucker has to gain what almost 50%, 60% for that don't make sense. Yes, that is right. A 50% move would be yeah. So this thing has to gain 60% for you to actually have to sell those shares. So if it's something that you want to hold forever, then sell super far out of the money puts, get free cash for just holding the stock, whether the stock goes up or down. In my opinion, the more theta you have in your portfolio, the better. We can go back to my Tasty, and I'll show you what my actual portfolio theta is. Let me change it right here. Tasty shows you your full portfolio theta. Hold on, it's not letting me switch. One sec. So change windows. Tasty. So now we're back on theta. My whole portfolio theta is 109. A positive 109 theta. So every single day, I collect $100 no matter what. No matter fucking what. Whether the stocks move up, whether the stocks move down, whether they don't move at all. If I have 100 theta in my full portfolio, my portfolio is guaranteed to at least come out plus 100 at the beginning of the day, and then go from there. And so that's one thing is I love collecting theta. Plug actually is a very good company to sell premium in. I'm selling the $80 calls. I might even sell more calls in it because it's got it's got IV, it's a consistent company. And so then this gets to if you don't want to get assigned or if you don't want these, like, you can manage your risk. So I have open. I have $25 puts. The stock price drops. I got it at 27, 28. stock price dropped down to 26. And so if I don't want to, if I want to sell, if I want to make less money and negate my losses, like just similar to a hedge, I could sell a $35 call. What's my delta on these 25 puts? Mine's a 39 delta, so you do about a 20 delta. So 35, $40 call, probably just a 35 is fine. Negate some of the delta risk. So now you have, instead of having a negative 39 delta, instead of having a 39 delta, you have 39 plus 26. You have a 15 delta roughly. And so this is where it gets a little more intense too. So now you have less risk. You've collected more premium. This is called a strangle. You've collected more premium, so now it's going against you. You can collect extra premium. You bring your break even down lower. So I collected, let's go to my positions. I collected $2.85 for an open $25 put. So 25 minus $2.85 is $22.15. Then if I sell a $35 call against it, it's only $17 extra worth of buying power. You're collecting an extra $115. Your break even has gone from $22.15 to $20 on the exactly. So now, even if you get assigned those shares, you're coming in at profit. You're gonna make money as long as it stays above $20. So that's a little bit of a management for it too. If you don't necessarily want to get assigned, if you want to bring your break even down even more, and then you can sell a call against your put and collect more premium, and that way you can either sell a call against your put or roll it out to further expiration. But whatever you do, you want to collect more premium, bring your break even down, and that way, even if you get assigned, more you have more chance of profiting off of that assignment. I had a space strangle that I ended up collecting, I don't know, $700-800 in, and I was three or four money dollars out of the money, and you just keep going, you keep rolling it. I kept rolling it, and eventually I became in profits. And so one of the theories is, if you sell a put, or if you sell a call, or if you sell strangles, you can continuously roll your contracts to make sure, and it's very, very difficult to lose. Very, very difficult to lose. What's the chance of GME dropping a bunch this week? We don't know. A gamble. GME could go up 100%, or it could go down 200%, or go up 300%. It's one of those things that is literally anybody's game. We can't. There's no TA behind it. No TA we could even do it, because with Robinhood dropping, they're just gonna go to a different fucking broker. All right. Do we have any more questions on Theta Gang?
Gang, gang.
Did everybody understand it a little more? If you have more questions, feel free to ask in those trading questions at any time, or just DM me or Playboy or anybody. We'll all help you. Like, there's no such thing as a stupid question, and especially with this type of strategy, I want more people to start learning it, to start doing it, because there's safer strategies. If you're having troubles with options, with buying options, and you're losing and shit, like, I mean, you shouldn't be, because of we're in play, but if you are, find other strategies, find what works for you. personally, I was not very good at naked calls when I first started playing options. I lost so much fucking money. That's why I now do spreads. You see, almost all I do is spreads. Whether I fucking 95% of the plays I make are just spreads, selling puts, selling premium. It works for me. Find what works for you. That's like the best thing. Because once I started stop trying to buy naked calls, stop trying to I don't always scalp. I once I stopped trying to do things that I've seen everybody else doing, I started making more money. I started focusing on what I like to do, what is good for me and what works for me. And that's when you make the most money. Don't follow everybody else. If you're not good at it, practice it. Do a paper like I traded on a paper trading account for covered for just naked calls for a long time because I would get too sketched out about them. It would go minus 20%. I would cut it and lose money. That's just something that I'm learning, and I was never good at entries and shit. And so now with spreads, you can withstand more. You can look at more pullback. You don't have as much delta in your contracts. Your my consistency is way better. And so it's just whatever you guys like. And what we want to do is we want to give you every single possible option strategy. Like I do every strategy now. I sell naked calls, I sell naked puts, puts, I buy calls, all of it. So I can sell in covered shares and selling them for profit so they don't get filled. Yeah. Yeah, so like my example with NNDM, I don't want to get filled on my NNDM covered calls. I fucking want to hold this forever. Sell it way far out of the money just to collect extra cash. Like this is actually probably a trade I'm gonna make even though I have covered calls in NNDM already. I'm probably gonna make another trade, sell another call in NNDM, like a cash covered call, similar to your cash covered puts, at probably a 25 strike or a 20 strike, somewhere around here, collect more premium, and I might even do a strangle 25-10. It's a little bit of an, I'd probably do, no, can't even get a neutral strategy on this. I would have to go this. A lot of times I would do a neutral strategy. But like I'm collecting $267 for playing the range. But if they go up, what happens? You sell your you sell it at that strike price. So let's say NNDM, I'm selling a covered call for 22.5 and NNDM shoots up to $30, you still sell your shares at 22.5. You're fucked. You're not fucked, but you don't collect that extra cash from it going all the way up to 30. You just you sell it at 22.5, and that's what it is. That's why you sell your shares, like you sell your covered calls for something that you're willing to actually sell the shares at. So, but if they go up, yeah, so that's what happens if it goes up. You don't lose money, you don't make extra money off of the shares going to 30 instead of 22.5. Hell yeah, I'm glad it clicked, bro. I'm glad it clicked. So if I'm selling covered calls, do I have to own 100 shares slash a contract on the same? Yes, you have to have 100 shares on that same brokerage account. And it's 100 shares specifically. You have to have 100 shares on that brokerage account. So I sold a covered call and the other stock was like 14 at the time. I sold it for 120. Next day it gapped up to 17 and I was at like 220, and if I want to close the position I would lose 100. I waited the next day and it was back down to 14 and I closed the call at $80 and made $40 profit off of it. Yeah, perfect. Yeah, that's if your covered call is down, don't fucking sell it. Just keep going, let it ride. Because it's either going to expire worthless or you're going to sell your shares at that price. And who cares? Most of the time you sell your covered call at such far out of the money that you don't mind selling your shares at that price because you're profited hella. So shouldn't do it on a stock you aren't really willing to lose. And if you do, I'd recommend going far out of the money. Yeah, I mean, if you don't, like, a lot of people sell covered calls in Palantir. I was actually thinking about selling a CCIV put on Monday. Are you guys still see my trading view, right? Or not trading view, Tasty Works. I was looking at the $15 for March for CCIV because it's at 22 now, and you can collect $220 for the 15 put for March, and that's beautiful. I have no problems with that. Pay 15 for CCIV, and then I mean if you have a cash secured account, it's gonna be 1280. You got your margin account, it's only 302, collecting 220 credit. So like for a margin account, you're collecting 220 credit divided by 302.50 that it's costing you. It's a 72% fucking profit. Like that's great profit percentage for your buying power for return on capital. 72% return on capital if it expires worthless. Like that's fucking beautiful. In 48 days. Like that's great. Let's say 300, let's say you have a $5,000 account and you're collecting $200 off of it. If you collect $220 off a $5,000 account, that's 4%. That's 5% of your account in less than 2 months. Less than 2 months. For free, pretty much. You just built your account 5% for damn near nothing. Not sure if this is the kind of question you would answer and it has nothing to do with data technique, but I am currently have an XPV expiring this Friday. The contract was worth 0.95 as of Friday. I bought in at 270. Should I hold or sell? Let me look at the chart for XPV. Uh, daily. Actually, it double bottomed. XPV double bottomed right here at 40, 48. See? It doesn't look bad.
Can I change you?
Double bottom right here.
We're gonna clean up.
Why did that
We're
not?
gonna clean up.
Oh, that was a ray. I didn't want a ray.
You need a nap. This is why you need a nap.
Yeah, so you have a level right here that it double bottomed at. I'd kind of watch this level, and if it breaks it, be a little more careful. Other than that, you're cool.
Okay, we'll have Daddy snuggle you, but we gotta clean up, okay?
Do options transfer from brokers from Robinhood Reable? Yes, they do.
Snuggle
You
Daddy.
can. I think they do.
Snuggle Daddy. Okay? You'll be fine. We just gotta clean up
All
down
right.
here.
I think that's all we got on Theta for right now. if you guys got any more questions, let me know. I can answer a couple more questions before we go if you'd like. My shit died. Can you still hear me? Alright. Yeah, I can answer a couple more questions if you guys need to.
Lana! Come on. Lana! Sweetie, Daddy's working.
I got it muted. She's fine.
Lana!
Until expires, the more money you make if the stock market stays still.
Lana!
Moana, yeah, baby, that's so pretty. Yes, sir. Longer days expire, the more you make if the stock market either stays still or moves back down. Yeah, pretty much. As long as it doesn't move up, like you're gonna make money regardless. If it goes up, you sell the price at whatever your covered call is, you make money. If it goes down, you make money from the covered call, appreciating for the covered call, depreciating in value and expiring worthless, and you still make money, and you rinse and repeat. Alright, y'all. I look for about a 16 delta. So what is the key delta you look at when choosing a put to sell? Generally, I look for a 16 delta. And it also just depends on your liquidity zones and everything like that. Plug, let's just say, was our good example. A 45p is a 17 delta. That's fucking perfect. It doesn't have to be exact. I usually like to keep it under 20 though. So a 17 delta is fucking beautiful. Anything under 20 generally is good. So what is a key group? Delta, pretty much. Delta is a key Greek. You want to keep your delta at right above under 20 generally. And just like Tyler said, I try to take profits at 50% too. Generally, I'll take profits at 50% or 21 days till expiration. I will roll or take profits. Or there's another risk management one that I have too that Tasty Works made up that I can post. I've posted a couple times. This is just optimal mechanics. If your position goes 30% in a day or two, it's not a bad idea to close it. If your position goes 20% in a day or two, not a horrible idea to close it. If it goes 50% in 10 days, pretty decent idea to close it. I mean, it's all your own personal risk management, but I like harvesting profits. I like taking profits, rinse and repeat. And so I don't mind taking that 50% profit, even if it goes up to 100%. Take it at 50, watch it, enter a new one, and rinse and repeat. It's all about consistency. The more trades you do, the more you're going to get used to it, the more you're going to be consistent. So, alright, y'all. Thank you so much. Have a good night or day, whatever time it is for you.